This webinar. Wonderful. Okay, I think we're live, or the webinar is open. We've coordinated shirts again. I actually don't know if we
There's like a 40% probability I'm wearing a gray shirt. So
yeah, I was gonna say it's high. It's actually lower for me, but it's still double digits significantly.
yeah.
I met someone for coffee earlier, and I had to quickly change my shirt before this because it's hot in New York, and the subway's hot too. I had a hot car, which was
Those are the best.
yeah, it's fun to watch everyone realize simultaneously and be like, oh no, like we gotta get off this. We gotta get off this car ASAP. So yeah. How is it? I mean, presumably even hotter there, but a dry heat, one might say.
Yeah, 105, 110 over here midday. So par for the course in August in Arizona.
That's a crazy number to say about temperature for humans, but
yeah, sweat a lot out here.
Yeah, exactly. Yeah, I have this. I got this very odd mineral water for my. Can't see it, but my Mashmeyer Ventures group. Shout out to the InsurTech VC community. But I have this crazy mineral water from Georgia, the country, and it's basically like salt water. It's disgusting.
A lot of magnesium in it.
A lot of magnesium. I'm enjoying it, but
there you go.
I'll take the more the better. Anyways, that is a weak segue into flood insurance. Just basically water being the only theme. And for anyone joining us, either now or in replay, hello, hi, I'm Stuart. I'm the founder and CEO of Marble. I'm joined by David, who I'll throw to in a second. But just as a quick intro of what this is our third in a series of sort of fireside, Zoom side chats about the insurance world. Try to keep it pretty low stakes, pretty informative. We've previously talked about homeowners and auto insurance, and today we're going to talk about flood and earthquake, and we may get into some wildfire as well, sort of these larger, but are often considered catastrophe insurance causes or events. But before I go further, I'll throw it over to David to introduce himself and talk about a little bit about the company that he co-founded, Young Alfred, and then I'll share something about Marble, and then we'll get into the topic.
Yeah, awesome. Hey, everybody. So I'm David Stacy, co-founder of Young Alfred. Been building the business for about 5 years. And really what we are is a platform for you to go online, compare and buy your personalized insurance, all completely digitally, all on youngalfred.com, no redirects, kind of no spam or cold calls that you'll often find in the industry. And we're working with about 50 insurance carriers across all 50 states. You can check us out on youngalfred.com, or you may start to find us in your favorite fintech app, or if you're closing on a mortgage within their own UI UX. So yeah, that's Young Alfred.
That's awesome. And yeah, I've worked with Young Alfred before when I was at better.com, which was a mortgage company. And then we work with Young Alfred today with Marble. And just for anyone who doesn't know or catches this on YouTube or wherever it pops up, Marble is really trying to build the sort of fintech application for InsurTech, the one hub, the digital ecosystem for insurance. So a place for you to unify and link all your policies securely. So home, auto, life, health, umbrella, pet, really whatever you have that protects the things you love. We want to give you one account to manage it. And we want to give you one account where you can shop for better rates with our partners at Young Alfred. And then we also want to give you a way to earn rewards. So we have, I think, what is really the only universal rewards program for insurance, where as you take actions with us that make you better risk or engage with your insurance, which is a huge household asset, we'll push rewards to you. So that's Marble. We're marblepay.com or joinmarble.co. I don't think we've landed on a final domain yet, but hit up either. And with that, we'll get right into it. And this is a timely topic, especially with, as we were talking about before the call, with the Tahoe fires and with Henri and Ida, both on the southeast and northeast. We have a lot of these sort of catastrophe events or large weather events, really, but in the insurance industry, often called CAT or catastrophe events. And I think what we'll specifically focus on today are two of these things, which are flood and earthquake. And the reason they're interesting is that these are events that are actually often covered in public-private partnership with state or federal bodies, because And to give a little bit of a preamble, when you have large events like floods, earthquakes, fires, that can take out, and David can correct me after I'm, to finish with this explanation later, but or as soon as I finish, but they're really tough for insurance companies because what they can do is they can take out a massive chunk of their assets that they insure at one time. And this can be sort of an existential risk for insurance companies whose job in many ways is to layer their risk in a way where they can stay solvent and continue to insure people for many, many years and across many situations. So when you have these sort of large events that can do hundreds of millions and billions of dollars of damage, insurance companies get really nervous. There's not really a way for them to underwrite them. And earthquake and flood represent kind of the two biggest in that space today, though I think, unfortunately, fire is sort of getting into that space as well. But is that largely right?
Yeah, that's pretty much how I would summarize it. The big point, I guess, is around concentration of risk, and carriers need to diversify. So I think the simplest way to think about it is, your insurance carrier doesn't really ever want to insure all the homes on your subdivision, for the reason being risk is so concentrated. And when you look at especially earthquake and flood, that can wipe out a whole zip code with a total loss. So it's just been really hard to find carriers that can privately insure against these disasters. That said, with more of the new data models that are coming out and different approaches to underwriting, we are seeing more private carriers come back to market in these. Hopefully we don't hit a major flood or earthquake Richter scale level 7 anytime soon and wipes them back out. But I think over the last 10 years or so, it's a more competitive market than it historically was.
Well, that's interesting, because I was reading about flood insurance sort of ahead of this. And the last time I really spent time reading about it was when I got licensed, because I think one thing for people to sort of understand is like context is like the NFIP, National Flood Insurance Program, which is a federally run flood insurance program, I think covers like 75%. It's a massive percentage of the flood insurance in the market. But over the last 3 to 5 years, you have, to your point, like you started to see a couple, Liberty Mutual has a flood program, a couple starting to move into that space and take market share from the federal government. Do they calculate? I guess one question I have is like, to the extent that I mean, the NFIP, I believe, has just sort of packaged amounts. Like it's 250,000 for structure and something else for contents.
Yeah, they'll cap you at 250,000 on your structure and then 100,000 on contents. So, if you've got a $750,000 house and you have a flood, you're pretty exposed there. That's where the private market does offer more flexible coverages, higher limits. Other things I know NFIP excludes traditionally is like loss of use coverage, which you might not think much about. You generally think, oh, I lost my home, the value of my property, but also you're going to have to pay to live somewhere else for potentially a really long time while there's a rebuild going on in process. So loss of use coverage is really valuable.
Rebuild. I mean, think about some of these images that we're seeing and think about how long you might be displaced.
Yeah, labor and materials, the challenge is demand spikes because everyone is rebuilding at the same time. I mean, now you can barely even, I'm going through a home building process and it's taking a long time because they can't find enough workers and there's delays on the supply side. And that's really just driven by a lot of demand across the housing market and some COVID delays. But factor that in with a total loss in one specific area, and you might be out of a living situation or be displaced for a really extended period of time. So yeah, loss of use coverage, you can get that from the private insurers. The way your personal property is replaced. So it's called actual cash value on the NFIP policy. And the way to think about that is if you have a 10-year-old couch, your insurance carrier is going to value that close to zero. So you're not going to get much of a check to replace that 10-year-old couch. If you have replacement cost, which you can get through some of the private programs, you'll get the cost to buy a new couch of like kind, make, and quality.
And then for those private insurers, I mean, are they calculate, because if people are reaching out to them to sort of bridge that NFIP floor, if you will, to my knowledge, like the biggest underwriting factor at the NFIP program are FEMA flood maps, presumably. But are the private carriers working off the same set of data? Or are they looking at other things like more proactive, like, is your house raised? I mean, are there things like that you can get a benefit for from the private insurers?
Yeah, look, my opinion is always check both and see what's available. Sometimes the NFIP policy is going to be more competitively priced. Other times a private is, because the private companies are, using their own models, and FEMA may deem your high risk and private deems you're a lower risk, and the pricing will adjust accordingly. So I also know FEMA is in the process of updating their flood maps, which is a really heavy lift on their end. It's not without its, kind of controversial social issues, because if you were in what you thought was a low risk zone and all of a sudden FEMA says, no, you're high risk, you just probably tank the value of your property, I don't know, 10, 20%, because the cost of your insurance for flood is now no longer $500 a year, potentially 10,000.
Yeah. And I mean, is this consistent for people who live in like earthquake prone states too? I imagine there's obviously some data, fault lines, areas like that. I mean, I think of California, Alaska, Washington as states. I mean, it's not something that we have here a lot, though I have experienced earthquake in New York, famously. I did feel the Virginia earthquake when I was on the 16th floor, which was pretty fun. But it's not something that we have coverage for. But I guess I believe California state offers earthquake insurance sort of as a state equivalent to the NFIP. Do other states do the same thing?
Yeah, there's other state-run programs, like with California, it's the CEA, that's California Earthquake Authority. It's definitely the largest state, but I would also say I think there's 16 states that have a high risk of earthquakes. There's some in the Midwest, Illinois, Kentucky, Missouri, Tennessee, and then most of the rest is on the West Coast, just depending on where you're at relative to a fault line.
Yeah,
I've seen 42 states have exposure to earthquakes, likely low risk. Like I know in Arizona, we got a notification from one of our carriers that like there was an earthquake and they're pausing writing business somewhere in Arizona. I was like, I didn't feel anything, but there is potential exposure there. So it's one of those things where if you are in a high risk state, you want to consider it more carefully, but it can also be prohibitively expensive.
I mean, to sort of segue, but did you ever, going through a home build, has anything, I mean, in Arizona, it really wouldn't come up, but there are obviously mitigation things you can do if you're in California to some extent, framing types, structural reinforcement. But is there anything that came up in real time for you as you were sort of selecting various materials?
Yeah, nothing actually came up on that topic, but I do know like there are certain things you can do to it's probably because it's in Arizona and no one talks about it, but like if you're in California, you probably want to have that conversation with either the seller of the home or if you're building the builder, because you can get cheaper rates. Like if you have a bolted foundation, actually, if you increase the number of stories of your home, that's going to drive your rates up. It's just like less stable, and brick is going to be more expensive to insure than wood, just less pliable. Like wood can withstand it. Yeah.
There's something like interesting about insurance where like the larger the catastrophe, the more human understandable it is. Like the underwriting risk of like the thing, like of a very like sort of small thing, like, a power line, a branch hitting, like a power line falling on your property, something happening, like that's obviously you can see it, but it's sort of like, I don't know how to understand the things I could do to even mitigate that necessarily. Like when you tell me like a bolted foundation, I'm like, yeah, I mean, that makes sense. Like the whole earth is shaking. Like, brick is more likely to break than wood. It's just like it. And the same thing with flooding. You're just like, yeah, I mean, it's so massive on a scale that I can kind of just grasp the things I can do, be on higher ground, have a more pliable construction.
Yeah. So also one of the interesting things I think, at least with regard to flooding, is it's easily understandable because of what you see on the news and mass destruction. You think of flooding as taking out entire neighborhoods. You see the water up to roofs, but flooding can also be a fire hydrant exploding, flooding
Yes.
more than two home. If it floods more than two properties, it's external water, it's flood damage. So it wouldn't be covered by your homeowner's policy. And that can cause a lot of damage. So
That's
that
actually,
stuff happens. That's more common in like New York, right? If you're
yeah.
if you're on the street, yeah.
I was just, and I want to come back to the home. I was just walking back from getting lunch, and over on 108th, they were doing construction. They hit a water main, and I'm just watching water flood into the basement of this apartment building on 108th and Broadway, and being like, and it's downhill to the park, so that's just going to be every brownstone is just about to be flooded by that leak.
That's flood damage.
That's flood damage, which is, I mean, it's worth double clicking on that, because I think people in places like New York or Arizona, or might think like, or places where you don't. I mean, Arizona actually does have more flooding, but places where you don't associate flood damage as a huge concern, maybe when you're operating, your home risk assessment. But knowing how insurers define what is covered in your vanilla out of the box home policy is worth knowing, and asking about. And I mean, so to that point, what is sort of water damage versus flood damage for a homeowner's policy versus flood?
Yeah. So the easiest way I guess I think about it is the water coming externally and did it damage more than just your property? That's going to be flood. Internal water damage, like a pipe bursting, water backing up through your drains, that's all going to be factored into your homeowner's policy. And there can be carve outs there. Some carriers will cap your damage on internal water damage if the home's older or you didn't buy the right water backup coverage on the policy. So it's not like guaranteed covered, but one is associated with your home policy, and then the rest needs to be on a flood policy.
Why is water so scary to carriers? Like like water is this area of constant carve out, exception, addition, backup cover. I mean, it's like, again, taking wildfire aside for a second, which I want to come back to, but like fire, wind, these are other big things that insurance companies seem to be like, hey, you're covered, it's fine. As long as you didn't cause it yourself. Water is this one sort of element where policy documents are full of carve out protections, exceptions. What about it is so scary to carriers?
They cause, I think, probably the most dollars in losses. It's got to be one of the top three, if not the top, in terms of what a home policy is going to protect for. And they also deem it as something that should be more preventable. So if you're keeping up with your home, up to code, not letting things be exposed to too much wear and tear, they see that as something that you should be able to like underwrite for and prevent. Whereas weather, you can't control. That is what it is. So it's going to damage what it's going to damage. But yeah, old pipes, I mean, it's just constant. You can have a small leak in your ceiling, you don't know about it, and it goes on for 60 days. And next thing you know, you have to do like a major interior pull out, rebuild, because the water caused mold, it damaged a bunch of things. So it's it just has very high losses associated with it, which is why the carriers, it's very price sensitive market. They do the carve outs to try and make their product more competitive. So what you find.
So then getting away from water for a second, back into earthquake, which is something that is so foreign to me in many ways. But just speaking even within Young Alfred, how much do you sell private earthquake insurance? How does that, like, how does someone shop for that? Actually, literally, how do you see people shop for it?
Honest answer is most people don't buy it because they don't want to spend more money. That said, like what we do, at least in our experience, is associate with your address. We'll map FEMA, how FEMA's defining your flood zone. We'll show you that, what your risk of earthquake is based on exposure to fault lines. And we'll show you, whether or not what your risk is, and then you can make the decision as to whether or not you want to purchase the product. We do place private. I'd say we place more private earthquake actually than private flood. Well, maybe it's pretty close. There's good options there. The reality is most people just don't want to buy it. It's insurance. Like if it's not mandated, you're not buying it.
Yeah. Yeah. I mean, it's, I guess, are there exceptions? Are there or I guess as a consumer, how do you look at an earthquake policy? Like in terms of actually as a insurance person, like, do you look at it and you're like, well, if I'm going to buy it, at least it's pretty like rock solid coverage, pun unintended, like solid coverage on like, there's not a lot of exceptions or carve outs, or do you find yourself looking at earthquake policies and be like, wow, like for the money, there's a lot of like sort of exceptions too.
I wouldn't say there's a ton of exceptions. The main thing you're going to want to focus on is what your deductible is, especially on the earthquake policies. In order to make them affordable, you can run into 10 to 20% deductibles, which, to put that in context, if you have a $500,000 home and you have a 10% deductible, you're paying $50,000 out of pocket before the insurance coverage kicks in. So that's a heavy, it's not self-insuring, but it's protecting against the total loss, basically.
Yeah.
But you can have damage and even have earthquake insurance, but it really doesn't even reach your deductible. So you're basically paying for the damage.
Yeah. And I mean, I guess that gets into one of the other questions we had written down here, but I mean, I think, and I can sort of take a crack at it, but this idea of how do you understand what supplementary coverage you might need for earthquake or home or flood rather. And I mean, I think the first thing you're going to want to do is, well, if your home is financed, you're going to want to look at what's required by the mortgage lender if you're buying new. Flood insurance is required by Fannie Mae. Earthquake,
you're in a high risk, yeah.
Yeah, if you're in a flood zone, yeah. Earthquake is not.
No.
And then that's from just the jump, you're going to look at that. Second, you're going to want to look at sort of what David said even 20 minutes ago, which is where your existing coverages begin and end, where that deductible is, your personal financial situation, and from there sort of build up to the amount of contents and like construction that you want covered, and figure out between the public and private market where you can maximize that for your budget. I mean, is that sort of the calculation that you would follow?
Yeah, almost spot on. Like how devastating would a loss be to you? Like, could you not recover from it if you didn't have the insurance, and at what level of deductible, can you cover? So there's I always blank on the name of this company. There's a company out there that's offering to cover your deductible on earthquake. So people are buying that. You essentially buy an earthquake policy, and then you also buy a policy that pays for your deductible.
Wow.
That's a lot of insurance to buy, but
yeah. What do you pay? So, and then that only kicks in if you make a claim.
Yeah, it's basically going to pay you. I don't know. We don't place those, so I don't know the specifics of the policy, but I think if there's a registered earthquake and it's the source of damage and you don't hit your deductible, like that should pay.
I mean, it's basically, you're basically inverse reinsurance. You're ceding the risk, the deductible risk, to another company.
Yeah. You're ceding all your risk.
That's very funny. That's like extremely funny that we've just built reinsurance on both sides of the marketplace now. That's actually kind of cool though. So here's something that I actually, right before we jumped in, I realized I sort of knew, but as a non-driver, as we've well discussed through these sessions, like you know, my car can get swallowed up, or something can fall on it from an earthquake, or get swept away in a flood. Um, does the NFIP program like cover my car as well, or is that a separate thing, or how does that work for autos?
Yeah, that would all go on your auto insurance. The policies you're buying on the earthquake and flood, it's for your property. And that kind of that holds true on your homeowner's policy as well. It's not covering your automobiles.
So it's just, you know, like, so, and then from what I quickly looked up, it's like that's where that comprehensive coverage kicks in, which is as opposed to like collision, is the coverage of your auto in the case of a flood, earthquake, and I guess wildfire. Would that also cover my car getting, you know?
Yeah, I believe so. Anything outside of collision is basically what comprehensive coverage rule of thumb is. I'm
Yeah,
sure there's exceptions buried
I'm
in these
sure. Yeah.
policies, but yeah.
So then that, I mean, as a quick aside, or deviation, like, has the wildfire um, risk treatment followed flood and earthquake? Like, are we moving to, I mean, I know even firsthand or secondhand, it's harder to get coverage if you're in a wildfire zone, but have state programs popped up? Like, how does a consumer handle that? I know there's been some talk about state programs. I don't know if they've actually been implemented.
Yeah, the big ones in California, it's the California Fair Plan, and kind of like state run organization that if the standard market carriers are not providing options, you check the fair plan. They We're seeing more and more binary outcomes in California, where if you're not exposed to high fire risks, most of the standard carriers are competitive, they offer good policies. If you are exposed, no one will quote you, no one will underwrite your home. So you have to go to the fair plan or an excess and surplus lines market, and kind of find these specialty carriers to place you. Well, I've actually, especially on the higher end of the market, like for high net worth, people who've had their home insurance with a carrier for like 10, 15 years, paying a ton, they're getting dropped. And they have all these other policies with that carrier too, but they're just not willing to write that because the exposure is so high. I do think, I don't know, we'll see how the market will change over the next couple of years. It seems like more carriers are willing to go into California and some of these other areas and offer policies. There's new data models coming out, new ways people are trying to like map the fire risk. So I think they should get more competitive. Hopefully, like, one way to think about it is like all these brush fires that have been burning over the last couple of years, like they're burning away all the brush. So there's less area that has fire exposure risk, at least near term. But the state's also so large. So I'm sure there's a bunch of areas that are also still really difficult. But if you've just had a big fire in an area, I'm not an actuary, but I would think now is a great time to go underwrite a home because everything burned away. There's nothing new to burn.
That is a very good idea. But I'm also wondering, like, are there any mitigation things that, like, like we talked about, like bolted foundations? I mean, I feel like to some extent you can do clearing, you can do, but like that is the other concern, right? Is that there's just nothing you can really do.
Yeah, you can spend some money and like try and distance your home and put up some sort of barriers around the ability of a fire to reach it. But at the same time, I mean, you see some of these fire stats and they're like, the fire's basically covering the length of a football field a minute. And, it's just moving at such high velocity that if you're exposed to that, it's going to be really hard to protect you. Some of our carriers have told us they saw fires jump like a 7-lane highway and hit a subdivision that they thought had, was really well protected.
And that again gets into this data problem, right? Where it's just like, I think some of the conservatism you're seeing from the carriers is partially driven by the existential massive catastrophe risk, right? but also that we're still building the data sets. I think back to like even, and again, with climate change, hurricanes are becoming less predictable, more ferocious. There's a lot going on there, but we've had centuries of storm data now. Lloyd's has been underwriting storms and maritime risk for generations. Like, so just the historical actuarial tables are like pretty strong for storms. I mean, we still get caught out all the time, but like over enough of a batting average, the odds makers are still doing pretty decently. Wildfire is like a totally different ballgame. Like we just don't have the actuarial data too. So you're almost seeing the unpredictability being priced in as well.
Yeah, I mean, I don't know if you've ever read Nassim Taleb, Black Swan,
Yeah.
Anti-Fragile.
Yes,
I think his point would be you can't really model those tail risk, and there is so much unpredictability in that. And hindsight 2020, like I think a lot of it's looking back has been poor forest management and actually not running like controlled burns and kind of allowing nature to run its course and burn what it was going to burn. And if you put the fires out too quickly, then you just have continued buildup. And so now when the one strikes, it's going to be very devastating, and no one was really modeling that. So
one of the things I found myself reading yearly now is California puts out like a fuel report where they talk about like the amount of unburned combustible materials that they're seeing. And that's like a shocking thing.
Interesting.
Oh, my internet might have cut out for a second, but it's just shocking to see how much still combustible material there are, especially on the West Coast.
Yeah, I've not seen any of that data, but
it's, yeah, I don't know, maybe don't look at it. It's like pretty ominous. So I guess, sort of start to bring this one home, but I guess typically when we do these for more conventional products, home and auto, we try to save some time to talk about, lowering costs, lowering exposure, lowering risk, lowering liabilities. This is a tricky topic to have that because, again, by its nature, earthquake, flood, and by the way, to sort of bring it up to contemporary conversation too, another type of catastrophe that has deductible in many places is hurricane. A lot of policies, just as another sort of nugget to check your policies, will have a hurricane deductible too. That you have to meet. And particularly, I think like Florida, Panhandle, or coastal Texas, you'll see that a lot. I don't know if you see it in any other states, but
really any state that has wind exposure. Okay. You can see not a hurricane deductible, but wind hail deductibles.
Yes.
In inland states, Colorado, Illinois, yes. Indiana, yeah. Like tornadoes.
Big hail places. Yeah, exactly.
Yeah. You see really high deductibles on that in Colorado with all the hail damage.
Yeah. And then, so are there things you're talking to a consumer that it's like, hey, let's stick with flood because it's sort of it's where we started, and I think it's what are the things that I could do to lower my costs, lower my exposure? Maybe let's say two scenarios. One is a totally new build, and one is someone who's home buying. What are the things that you would do?
Yeah, the number one thing I would do is shop, to be honest. Like, don't take the first option that comes your way. Make sure you check FEMA, NFIP, and then the private options. Get an elevation certificate that can be used to, especially if you're in a high risk zone. Maybe you find like with an elevation certificate, it's not actually high risk. So that can lower your premium. And the other like kind of lever you have on cost is your deductible and how much coverage you want. You don't have to buy up to $250,000 of coverage. Like you may be fine depending on the value of the home, just buying $100,000 or $150,000 of coverage with a reasonably high deductible, and it's gonna cover you if you have like a moderate flood loss. Yeah. So it is a lot of, I think, doing the work up front, like making sure you understand what the flood risk is. And if there's a really attractive property, but it's in a high risk flood zone, just understand like what you're signing up for price wise. Does $10,000 a year in insurance make that property worth it? Because it's going to be hard to sell.
Yeah. I'm realizing like right now as we're talking that I don't think we have flood insurance in the Marble law yet. And we should add, that'd be useful for people, I think. Yeah, I think, it's almost like you talked about this actually last time as we were wrapping up how you approach your auto insurance, right? Which is that like carrying a high deductible and really being like, and that's just your personal position. And I think it is, it's unpleasant math to think about. And often it's not readily available numbers because you have to get into rebuilding costs, things like that. But when you're looking at a risk that is by its very nature a total raw loss risk, where like if it happens, you're probably losing the whole property. Looking at it in those terms of what you pay per year, what the cost to resell the property is, and what the cost to rebuild is sort of the 3 columns in the spreadsheet to think about.
Yeah, I actually like as you're laying that out, I think people are more understanding of, they intuitively do that math on their health insurance because you look at it each year and you go, am I going to be going to the doctor a lot this year? What sort of deductible do I want? Or am I healthy? I don't really see a need that I'm going to be going to the doctor a lot. I just want to protect myself if I get something that's going to run up $100,000 in medical bills.
Yeah.
And it's that sort of same logic I'd apply to your personal lines insurance.
Yeah. That is all the questions I had. Anything that we should cover before we conclude here? Anything you want to touch on?
Yeah, I've got a stat. I'm curious how you answer it. How many registered earthquakes do you think there were last year?
Registered earthquakes. So I ask follow-up questions, or I have to answer? Do I have to answer?
You can ask a question. I don't know that I'll have like a very detailed.
Well, I'm curious. Is there a Richter scale threshold for a registered earthquake that you know of? Or does it just have to?
I think that it hits the Richter scale.
Yeah,
I mean, it's an earthquake.
As I asked the question, I was like, maybe if it just hits it at all, then it's an earthquake.
Yeah.
How many? Wow. This is one of these questions where I feel like it would only be worthwhile trivia if it's a ton or if it's like way fewer than you expect. Last year.
Yeah.
In the US. So where I'm thinking now is, am I going, there's no seasonal application, it's year round, I think.
I'd assume so, but
yeah. I'm trying to think, is it like more than 1 or 2 a day? I'm gonna go with 365. I'm gonna go with 1 a day.
73,000.
Oh my God, not even close. Oh my God.
It was one of those that was gonna be,
I knew I should have swung way harder at the top end of that. Oh, I was literally was doing, how many times have I seen like West Coast VCs tweet about earthquakes? And I was like, well, the frequency is not that high, but that's just a tiny part.
Yeah.
Wow.
You don't know most of them hit. So
yeah, that is a lot. And you said Nashville is an area too. That's confusing to me, but
Tennessee has fault line.
Fault lines, I guess.
Yeah.
Wow, that is good trivia. I'm in this trivia league, so that's good because I need to know this sort of stuff. So
exactly.
Wow, that was excellent. We should when we do this again, we should do every time with trivia. This is great. It's great to feel like it's great to flounder in public. Thank you everybody for joining. This was a great session. Please check us out on the Marble channel on YouTube. We have 3 of these. David and I will probably.
Uh-oh. Freezing on the way out.
My internet's back. That's fine. Talk to Fios about that. We'll figure out more of these. If people have topics they'd like us to cover, I don't know, tweet either. I don't really know. Use any of the forms of communication, comments on YouTube. Check out Young Alfred to shop your rates. Check out Marble to store all your insurance in one place and take control of it. Anything else before you go out?
I think you covered it. Good conversation as always.
Awesome. This was fun. All right, I'm going to hit stop recording and I'll see you later.